Well, small businesses are meant to be the engine of South Africa's economy, but for too long they've been running on fumes. Despite all of the policy promises and big talk from both government and the private sector, the reality is this: most SMEs in South Africa still really battle to access the funding they need to grow, to hire, and to contribute meaningfully to the South African economy. Banks say they want to fund more entrepreneurs, but a lot of red tape and risk aversion does still choke off the supply. And entrepreneurs say they're ready to scale, but many can't produce a formal balance sheet, let alone a digital credit score. This is the Monocle Banking Podcast. I'm Michael Avery, and we're talking small business, big ideas. Let's get stuck in. Well, my guest on the Monocle Banking Podcast this week is Andiswa Bata, the CEO of FNB Business. They've got new facilities from the IFC and a R2.5 billion social bond in play. So FNB is really expanding its SME lending capacity. But can banks move the needle in a country where most small businesses still can't get past a loan application form? Now, that's the big question. Andiswa, welcome. Let's firstly just start with your remarkable personal journey from your early days in Zwelitsha to leading SME banking at FNB. What experiences have most shaped your thinking as a finance leader today?
Firstly, thank you very much for having me. And I'm really excited about the conversation we're about to have about SMEs, which is a particular passion point for me. But let's first reflect then on that career and personal journey. So as you've mentioned, I was born and raised in the Eastern Cape. And probably one of the first defining moments was, unfortunately, to get out of the Eastern Cape, because I had the opportunity at the time to then go and study at UCT and do a business science degree. And to be honest, that was the game changer, because armed with a qualification like that, it then set me up for a career in finance and to then build the foundations for what I am today. So other than a brief stint in consulting, I've then been a banker for the last 18 years, mainly in corporate and investment banking, but for the past 7 years, proudly working in the small business space, particularly because I'm passionate, but also because I feel that the more bankers are focused on the space with passion, then I really hope the more problems we can help to solve.
I think it's a great summation. I've got to ask you, were there other bankers in the family? Was finance in your blood, or was it at UCT that the finance bug really bit you?
Interestingly, so my mom actually was a civil servant and my dad a school teacher. So there wasn't that much of the career development or exposure in particular to finance or banking. So how I actually landed up on this is that in matric, I looked at the UCT prospectus because I knew I wanted to go to UCT. And honestly, it was as simple as I chose the thing that needed the most marks to get into, because to my simple brain, that was going to give me a good career. And so with that, the two things were business science and or medicine. And I knew I didn't want to become a doctor, so I went the finance route. And that is then how the cookie started to crumble into essentially a career in finance today.
It's remarkable how those early choices can really define our lives in that sense. And you mentioned you've held roles across CIB, Standard Bank, Barclays, across investment syndication, structured lending, that kind of thing. How has that shaped your view of risk and opportunity in the SME market?
I suppose having been exposed then in the investment banking space to funding at scale for large corporates, listed corporates, big state-owned entities, you get the lens of essentially how bigger corporates tackle their funding requirements, needs, and how they set themselves up. And if I contrast that to the space that I operate in today, where I support mainly small to medium enterprises, there are a few differences. And some of those actually come down to simple things like governance and making sure that you separate your personal and business finances and making sure that your business has at least some financial track record that they can use to then evidence their performance to become eligible for funding. So it's even some of those micro, smaller things that we might take for granted that I think more well-oiled big businesses have a better appreciation of how to get themselves funding ready and what they need to be able to evidence that performance in order to get the funding. Now, that's just one aspect, because I think what's then happened in South Africa, in particular over the last few years, quite excitingly, is that the market has started to move away from then that traditional lens of lending to SMEs based on the traditional way of doing things. I think it's exciting that we've seen the emergence of funding solutions like merchant cash advance, which rather seeks to say, well, let's trace the business's cash flow using the revenue that we can see the business is earning from their point of sale device, or a speed point, as we call it, and deriving an assumption as to how much revenue then the business is making and therefore how much funding that they could attract. Similarly, there's been advancements whereby banks pleasingly are moving in the direction of scored lending, which ultimately means that instead of an SME having to produce an income statement or a balance sheet, because we know that SMEs don't have the money to pay an accountant on retainer to produce financial statements, pleasingly, a lot of SMEs, especially in our base, access our scored lending facilities, which simply uses the transactional data in the SME's business account to then derive an assumption about the free cash flow and therefore how much debt that SME can service. So even though I think the world is shifting because it had to, I think it's really cool that actually we're starting to see some of those emerging things starting to help.
And Andiswa, it sounds like you're speaking like one of those alternative lenders, Merchant Capital or many others that have emerged over the last 10 odd years that use these so-called non-traditional metrics to help extend credit to the SME sector. It's so refreshing to hear this coming from the head of FNB, which is already the largest SME lender in the country when it comes to your portfolio in your book. How have you shifted internally inside the bank to this kind of thinking, given that we know big banks traditionally are like oil tankers? They don't move necessarily as agilely or as quickly as some of the smaller players in the market.
So for us, it's been a journey, if I'm honest. Our scored lending approach for businesses is something that has been in place for actually, I think, the better part of 10 years. And we've just managed then over time through the use of data and analytics to sharpen it and make it better over time, to the extent that today our business clients can on their app apply for funding, and our model can use those historic cash flows simply just by looking at the activity on the bank account itself to generate an actual credit offer, which could be then at the election of the SME if they want to take that in the form of a business loan or a business credit card or an overdraft. So we've even evolved it that far that we are able to present the client with 3 options as to which type of credit they want to take, to the extent, obviously, that the answer from the scored lend approach is a positive credit offer. When you ask me, how did we even get here, Michael, it's because being really deeply passionate about the space, we make it our business to spend as much time with SMEs as possible to understand how do we need to challenge ourselves to better solution for them. And in doing so, it becomes incumbent on us to then make sure that we move those big ships that you described, because we are also one, and yet it's something that we have then made sure that we have the best tech system, IT systems, to be able to handle these kind of solutions, to make sure we have the best product specialists, the best pricing specialists, the best data and analytics teams. Credit risk also needed to evolve over time. It didn't happen, I suppose, in one day or by mistake. It actually happened through action of systems development, talent, people development to get us to the point where we can do and say these things proudly today.
Yeah, and you've got that data. I mean, it is underpinned by data, as we've seen. And post-COVID, you must be sitting on a lot of data to give you insights, both financial data or behavioral data, into the SME small business landscape. So what is FNB learning from some of that transaction data and behavioral trends, or even utility payments, that's helping you better underwrite SMEs today? How have they fared since that COVID period where sadly we lost so many small businesses?
When I think about the future, because I'm going to tie this response to the future of where I think the SME funding could be going.
Yes.
As I said, I think we've already started to make good strides, moving away from the rigid way of saying, give me your income statement and your audited financials, and then I can lend you money. Thankfully, as I said, there's different solutions now that are already live that are very helpful in making sure that we start bridging some of that gap. And then when I think about the future, it is 100% data-based, because even the examples I've cited to you already, be it scored lending, which is cash flow-based lending, and or merchant cash advance, All of those still ultimately are taking, financial data to derive a decision about
Yes.
funding readiness or offers. It's still a data set that is something that a bank, for example, has in their own fingertips. Where I think the world is going to have to move is exactly, and I've heard you talk in previous podcasts with other speakers about how do we now move this further and get those customers that have a very thin credit file,
Yes.
a very little financial data, and derive an understanding of, well, is this person willing and able to repay a loan?
Mm.
So, where do I think the world is headed? I think in the not so distant future, we're going to be using other proxies from a data perspective to say, actually, is this SME likely to repay this money? And when I think of the things that indicate your willingness as a business to repay your obligations or meet your obligations, I start with simple things like how regularly and on time are you paying your own suppliers? How regularly and on time are you paying your staff, your employees? How regularly and on time are you paying your municipal bill? Those are now not necessarily the classic ways that we would think of measuring willingness to repay. And yet it shows
Yeah.
when you've paid your rent, your staff, your municipal bill, things like that, that actually you have a high propensity to be a responsible payer on, for instance, a bank loan. And so if I can think about, using my crystal ball, the kind of things that I'm really excited to see the market moving into, it's exactly that. And as you say, data is key.
And it means we're finally moving away from the kind of legacy credit scoring models that punish informality. And I think to an extent, we're starting, that Overton window of the debate that we're having around how we better service the informal sector, the township economy. You go back to Thabo and Becky's years where he called it, the second economy. It is thriving. I'm not so sure I agree 100% with what Harry Fourie of Capitec has said about it indicating that we probably got unemployment closer to 10%. I think there is a lot of activity, but I think that's debate for another day. But what it does indicate, and what you're saying, Andiswa, is that we're finally embracing non-traditional credit scoring methods because South Africa does have the legacy of apartheid to deal with. I was chatting to the head of the Franchise Association recently, and it's a great model. They have very high success rates, very low failure rates for new businesses, which is not what you tend to find with a new enterprise. But he said the problem is to bring in, new black businesses in the township. They don't have assets. They don't have ways to go and access traditional capital from the banks, which they need to start these businesses. And they obviously can put a bit of their own skin in the game. But that is a big challenge. And, they look at entrepreneurial readiness and they get to know the entrepreneur. But it is still that capital hurdle that is a hurdle for them. So from what I'm hearing you say, the banks will hopefully start to be able to lend in a way that is still prudent, because I think on the other side of this coin, Andiswa, is this: we need to understand that ultimately banks are deposit-taking institutions. Your fiduciary responsibilities to your depositors. So you can't just go and lend and lose money willy-nilly.
So I'll touch on your last point first, which is that I think is often misunderstood, that last point, because banks genuinely, how do we fund ourselves, is exactly the positive balances that are sitting in everybody's savings and check accounts. In other words, deposit-taking activities. Then it's a combination of also then looking at raising funding, debt funding. The bank also goes and raises money via debt instruments and other. And then we also partner with the likes of developmental finance institutions who also partner with us to provide us with facilities that allow us to further then on lend. My point here is that the way that the bank funds itself is in fact a component of many different sources of funding. And to each of those sources of funding, there is an obligation for us to then go and on lend that money responsibly, because we then have to make sure that we're able to return those people's money as we have agreed. And particularly to make sure that when you, Michael, go to an FNB ATM and you put your card in to access the positive balance in your own account, that will be there. So, that's a really important aspect that I think is often underestimated and misconstrued. And I'm really glad that you asked me to touch on it, because it's not that we don't want to help in all instances. It's just that we also have to wear that hat of not undertaking reckless lending. then on the, let's call it township economy, and I love to underline township economy because I think there is nothing informal about it. If you actually were to spend some time, I think you'd find especially things like the supply chain in the township, how the spaza shops tend to stock themselves to be able to put that washing powder or bread on the shelf. It is everything from how sophisticated the hair salons are in procuring wonderful weaves for their customers. It's in the distribution channel for pharmacies that are thriving in the township. There is a lot of activity that I think, because it is not documented in the classic way that we love to recognize statistics, it's then deemed informal. But actually, I think there's nothing informal about it. And so I rather prefer to call it as the township economy. What we see is that, particularly post-COVID, the businesses that we bank that operate in the various townships in South Africa are thriving. Because I think it was partially COVID that was the realization for a lot of people that they no longer needed to get into 3 different taxis to go to the nearest town or previous CBD or suburb in order to access medical care or buy groceries. And so as people have increasingly understood and embraced doing business closer to where they live, learning closer to where they live, and enjoying themselves closer to where they live, we are seeing everything from schooling, healthcare, entertainment, restaurants, etc., thriving in the townships. And in fact, it's one of our biggest growth nodes from an FNB business perspective, where we see growth of our customer numbers within the township far outpacing our national average. The amount that we lend into our township businesses from a year-on-year growth perspective is at least double of our national average,
Wow.
as is investment activity that those same township businesses are doing in terms of saving their spare cash in investment products. So as I said, I think for me, I'm really excited actually about the township economy and the opportunity it presents going forward. And I'm looking forward to ever more of financial services providers climbing in alongside us to try and make more impact.
Isn't there a huge opportunity, Andiswa, as well, for sharing of information to these township businesses, be it cash flow management, basics, guerrilla marketing, and just to further deepen the education and build the knowledge in these ecosystems? And they are little ecosystems, as you said, and especially since COVID. Now, you've just secured 1.8 billion rand via an IFC risk-sharing facility. Speaking of your various funding lines, at 2.5 billion rand through a social bond. How do these facilities change the game in terms of appetite and risk tolerance and lending models for you into the SME sector?
Sure. So what these funding lines allow us to do is the following. Is that as we charge along, because I think you can tell we were not waiting for these kind of funding lines in terms of activating, our interest and trying to make an impact anyway. What this actually allows is some additionality, actually. It's an opportunity for us to partner with other institutions who don't quite have the same market access to SMEs that we do. Because being really privileged to have over 1 million business clients in our portfolio, we have a natural link to SMEs that, for instance, the IFC might not, or that other institutional investors in South Africa might not. So it's an opportunity for them to partner with us, either in terms of sharing risk or providing funding that we can then on lend for the purpose of utilizing the fact that we already have the client base and the insights and the data, as I've explained a bit earlier. And so that's at its nutshell what this is. It's an opportunity to partner to expand finance options to SMEs. So how do these SMEs then apply? Actually, we've embedded these facilities within our actual normal credit or lending origination process. So there is no separate process that an SME needs to follow. They simply need to access either the FNB online banking or the app, the usual channels, to be able to understand if they do have an offer, and if not, they're welcome to follow the application process. And then we will then make sure that the funding in the background that was secured is then allocated towards these specific needs. Because these facilities that you've mentioned require us to use the money for only specific reasons. The social bond, for example, is only for women in business. And so we will then make sure that as we originate women in business lending opportunities, that we then apply that funding towards it. Then on the IFC risk share one, pleasingly, actually, the focus is on a whole host of use of proceeds, including youth and township economy as well, features there as one of the focus areas. And we also then additionally have a green lens on that one too, where a specific requirement as part of our IFC risk share is that part of the funding also be used for climate-friendly purposes or to advance climate funding. So it's in our normal rhythm here that we are in the business of trying to support SMEs as much as possible. And these arrangements simply help us to enhance that risk capacity, funding capacity, and be able to provide more.
And I want to come back to the statement by Capitec CEO Harry Fourie, and that real unemployment rate may be closer to 10% if we count what he calls informal entrepreneurs. You may call them township entrepreneurs. What's your take on that view? Is it a useful reframing? Is it maybe slightly misguided? What's your sense, given the data that you've got at your disposal and what you just shared about the vibrancy of the township economy since COVID?
I'm not sure what data sources they would have been using to inform their view. I think we acknowledge and use and respect the Status A view, which does indeed, I think if I double click into some of their definitions, include a very robust definition of what unemployment actually is. As it pertains to my seat, I think we don't take a view that is different to what Stats SA has produced. Having said that, I do think that there is an amazing opportunity, as I said, amazing activity happening in the townships. And if anything, I'm really excited that we try and bring as many of those into formally financially included spaces so that, if anything, for the future, we can further enhance our data sets and our understanding of what true unemployment is.
Let's talk about the real cost of banking then for those SMEs and for all SMEs really in South Africa. You've got transaction fees, you've got merchant services, you've got POS, or what you refer to as speed point devices, you've got FX margins. If you're an importer or exporter, you've got monthly charges. It's a stack that can add up quite quickly. Where is FNB actively looking to reduce costs for small businesses?
I think one of the biggest areas, particularly over the next couple of years, where you will probably see some pricing compression, is on payments. As the regulators, us as financial institutions and society, I think, demand further and further that payments be not only easy and convenient and safe, but also cheap and real time. I think we will start to see the fruits of some of the investment that has then been made into building payment rails or systems, as we call them, to enable cheaper, faster, and reliable and safe avenues for customers to be able to make real-time payments. So I think that that is one area where we can expect to see pricing to compress, because as we then seek to make payments as widely available for financial inclusion as possible, it's obviously then important that those channels be as affordable as possible.
Yeah, and it is something we've discussed on this podcast quite extensively, RPP and our payments modernization drive. So that's really encouraging to hear. SMEs often juggle multiple platforms as well. You've got accounting, you've got payroll, you've got invoicing, you've got card terminals. Often there's very little integration though. And I know FNB has built out a very strong digital platform. How close are we to kind of single dashboard where an SME can manage everything from cash flow to compliance?
I think that's a fair challenge, firstly, because as you say, SMEs are so busy trying to run business and grow their businesses that it's incumbent on us to try and make it as easy as possible for them to run their business then and their finances. And so over the years, we have made some investment into ensuring that we build out our capabilities to allow SMEs to transfer their, for instance, FNB transactional bank data to their accounting platform, or that the SME has chosen to use, so that it makes it much easier to start drawing up financial statements within that accounting platform. So those types of integrations are already live and happening. Where I think the world is definitely moving, Michael, and it's such a fair challenge, is that we're going to see more of it, because it's not just the accounting systems, it's also then the HR payroll system, It's also then different invoicing system, etc. And I think without setting an expectation here that you come and ask me again in 3 months, I think you can look forward to further advancements in the space. Let me leave it at that.
No, that's
because
fine.
I'm very much aware that this is a need.
Absolutely. It's on the agenda. I know there are many agenda items I'm sure that you're looking at the moment. Back to your point about payments, because, as transaction margins compress, which they'll have to, will banks need to start monetizing insights or business services rather than the payments themselves? And banks are businesses as well at the end of the day. How do you think about this margin compression in this area impacting maybe looking to monetize other areas of the banking stack that you offer?
Thankfully, I think that there's still so much of South Africa that has not been well served from a banking perspective. And therein lies an opportunity, because I think if we are only to take the lens that traditional banking is under pressure from a payments fee pressure perspective, then frankly, yes, that does paint quite a gloomy picture. But if we lean into the other pockets of growth where there is still quite a lot of white spaces and opportunity and activity, I think we'll be fine. And we spoke a little bit earlier even about the township economy and leaning in there. I think there's certain other industries that still could very much do with more enhanced banking solutions. There's other banking products and services that we could provide. So I think the name of the game isn't so much that the fee compression coming down the line from a payments perspective will be the end of banking, certainly not. I think it's then just going to do the right thing, which is to push the banks to go further where they haven't before.
Absolutely. And, competition's great for the end user. That's why we love free markets on this podcast. And we've got through half an hour and we haven't even touched on AI. So I'm not going to touch on AI, but I am going to ask you finally, Andiswa, if we sat down again in 5 years, what would success look like to you in terms of SME development in South Africa, obviously, and maybe even beyond in the broader region, and FNB's impact on the sector?
I'll start with a broader wish, which is that I really hope for more broadly the economy to grow, to help stimulate growth then of SMEs. Because we can talk and solve and hustle all we want, but if the economy is not itself growing to present as many new opportunities for businesses to thrive, then we're always on the back foot. So if anything, I'm really looking forward to hopefully some implementation of some of the structural reforms and plans that our government has in place in partnership with private institutions, because I really think we have to first and foremost have a growing pie here in order for businesses to then thrive. And so I'm hoping, that's my wish, that will at least in 5 years be presenting more natural organic opportunities. Then for SMEs, I'm looking forward to the following. I think we're going to see far more of our SME banking activity happening on, in particular, mobile phones and apps, because I think businesses are embracing the fact that they can do their banking on the go, make a payment, pay a staff member. They can present their phone these days with a QR code to receive payments from their own clients. So if anything, I think the way the world is moving is increasingly digital, and that we can expect to see more and more functionality being put onto digital platforms safely and hopefully user-friendly enough that SMEs make the most use of it.
I think that's bold vision I can certainly get behind. Andiswa Bata, thank you very much. CE of FNB Business, proving that with the right leadership, banks can do more than bank. They can build here on the Monocle Banking Podcast. Take care.
Thank you.
Well, whether you count them or not, millions of South Africans are building, trading, hustling and surviving in the margins of the economy. The challenge, and indeed, as Andiswa has pointed to, the opportunity, is how we meet them with the right capital, the right support and a bit of belief. This has been the Monocle Banking Podcast. As always, I'm Michael Avery, and don't forget to like and subscribe and share among your network. I'll see you next time as we keep asking the questions that matter for the future of finance. Take care.